Welcome Hidden Gem fam. In this video, we're going to dissect Defi Magick's video that he released about an hour ago talking about Rebase DAOs and how they're dead. Well, we're going to really dive into it because he goes in and talks about a few different points, and I have massive amounts of notes that I took and kind of what my thoughts are. So again, as you know, I've talked a lot about Wonderland, I've talked a lot about these Olympus DAO forks, and kind of what I believe is about to happen. Now, he brings up some very good points. I don't want to waste too much time. I want to get right into it. So the very first point that he starts off with is around 42 seconds. And by the way, I'm going to link this video in my description so you can take a look at it as well. And if you go and watch it, just let him know that I sent you as well. Now let's break it down on the very first part.
Main underlying problem, and that is the Ponzi-nomics. Basically, the success of the project depends entirely on new investors coming in to pay off the old investors.
Okay, so he basically is saying, you know, this is basically a Ponzi in so many words, because the traditional model, which is correct, is, you know, you're basically taking from Peter to pay Paul, right? So a constant new flow of investors need to come in order for the previous investors to make money. So, you know, given Ponzi-nomics or greater fool theory, however you want to label it. So the thing that you have to understand is that a DAO's purpose isn't to have revolving money. The DAO's purpose, since it's liquidity owned by the protocol, meaning that the protocol, when you buy or mint these tokens, right, for the actual DAO, the liquidity, let's just say you pay in Ethereum, the Ethereum goes to the protocol, not the AMM. So let me break this down for you a little bit deeper, is that we take a look at something like Uniswap. Now you're saying Uniswap has nothing to do with the DAO, just listen. So right over here, if we go to pools, you see how these pools, they're liquidity pools. So USDC, Ethereum, individuals have to come to Uniswap and provide liquidity. So this right here is a liquidity pool owned by Uniswap on the Uniswap protocol. However, if we look at a DAO, instead of actually being on Uniswap, the liquidity, these pairs, these tokens are actually inside of the DAO. The DAO owns this, not on the open market like Uniswap. So just kind of get how, get the overview of this. Now, the thing that I really want to address here is, yes, the Ponzi-nomics aspect is somewhat valid. However, what is failed to mention in the beginning, which again, he goes into a little bit later on, is that a DAO's main purpose is essentially to invest into outside investment vehicles via the voting structure of the DAO, of the organization. So long story short is, yes, the traditional DAOs are all about rotating money, right? So new money coming in, paying off old investors. However, the entire structure is supposed to be deploying the treasury assets to make more money, to then give dividends or rewards, however you want to go ahead and call it, to the actual holders and the participants. So that's the very first point. I actually, I really like this point, but again, I don't necessarily believe that it's Ponzi-nomic. Again, this is really hard to say. Yes, it's Ponzi-nomics, but it's not supposed to be that way. It's supposed to be, and I'll mention this in a bit, almost treated like a SPAC at this point. So again, let's keep going.
Whereas the Fed calls it quantitative easing, we have an even prettier term. We call it token emissions, and many people simply equate this with rewards.
Okay, so what he's saying is basically the way a DAO works is almost like the Fed, the US government, printing more money. So again, they call that quantitative easing versus emissions when it comes down to rebases on a DAO. Now, here's the thing, is that yes, he's absolutely correct. This is going to cause inflation. However, we'll take this even a step further later on, where he talks about a protocol, a particular project that I mentioned a while ago, and I got burned over the coals for mentioning it. But finally, somebody else says the same thing. So let me just say, we can burn and have an exact supply amount. So here's the thing when it comes down to money printing, right? Is that it's, yes, we have statistical data to tell us how much money is being printed. However, we also have the ability with these protocols to initiate burns. Now, that's something that's been up for debate, and something that necessarily hasn't been implemented yet is that these protocols can burn these tokens, whether it's the native token or whether it's the rebase token. But if there was some mechanism to burn then it would be a hedge against the inflation for the rebases, if that makes sense. So let's just take Wonderland Time, right? So we have Time, which stopped minting because they closed down the bonds. So now the time that's in existence is finite. That's it. However, Wrap Memo is still producing rebases. There's still emissions here. And so obviously the more rebases there are, the greater the inflation is because there's more supply. Now, the problem is that if there was a solution in order to go ahead and burn these particular Wrap Memo tokens for X, whatever X may be, then it would be a hedge against that inflation. So again, he's got a really good point here, but it's also really transparent on the blockchain with how many, what the actual supply is, how many circulating supply of the native token versus, what the current rebases are, the index. There's more transparency than we see with the Fed. So it gives DAO that upper hand, if you will.
Anytime you try to mint or create more of it, you dilute the value of the base currency. So
I agree. So anytime that you mint more of the native token, which produces rebases, it dilutes the value of the actual main currency in question. All right, so I agree with that.
Insanely high, unsustainable APYs. Admittedly, it was a clever tactic. Here we had a fancy countdown timer, and every 8 hours we would magically end up with a higher balance of tokens. And
so he's basically talking about the epochs. Essentially, every 8 hours for Wonderland, there would be one epoch which would go ahead and produce and mint more rebase, essentially. So he's basically saying that the whole APY structure was a gimmick. Absolutely. I've said this from the start. I've said this for months already. APY is a marketing tactic. What you had to pay attention to was the ROI daily. So the ROI daily and the 5-day ROI as well that they provided on every single staking platform, whether it's Wonderland, whether it's Ohm, whether it's Heck, it all had the 5-day ROI. And that's going to be the true ROI. The APY is essentially just all of that compounded throughout an entire year, but those numbers fluctuate. What you should have paid attention to, and what nobody did, was the APR essentially, and the ROI over that epoch versus over that 5 days. But everybody looked at the APY in totality. And again, the APY has always been a marketing gimmick because it's compounded if you leave your money in there. However, it doesn't necessarily give you the ROI that comes immediately from what you staked over the most congruent and relative time period to when people hold. For example, do you really expect somebody to hold throughout an entire year, when they're 90 days in and it's compounded, 90 days in? Again, those numbers become very skewed. So he's absolutely correct. APY was a fantastic marketing gimmick. So I can't argue here. It's a very valid point. However, it doesn't mean that it wasn't possible to make money. The possibility to make money with these rebasing DAOs still through the roof. Let's keep going.
If you take them away, what is the functionality of the protocol?
Very good point. If you were to remove the rebases, what is the functionality of what's existing right now? Given the functionality, as I mentioned in the beginning, should have been deploying the treasury assets in order to go ahead and provide some sort of rewards and dividends to the holders.
A revenue sharing model, offering buybacks and burns and other such mechanisms to drive up the price of the token. But for the most part, they've either stopped rebases and the minting of tokens altogether and not added a value capture mechanism, or they are continuing on as usual and the token printers are going burr.
It was like awkward burr I've ever heard. But again, they changed the narrative. He says it exactly as is. They changed the narrative. In my opinion, these DAOs are now starting to act like SPACs. And again, that's way better than being a Ponzi-nomic type of token or protocol. However, these DAOs are, yes, they're SPACs essentially. But the whole point of a SPAC is to raise the capital to be acquired by a separate entity. And that separate entity could be another publicly traded or private company, etc. So even though I said yes, it acts as a SPAC in the beginning, the SPACs, the whole point is to raise money to be joined into another conglomerate or acquired by another conglomerate. So that's why SPACs, have really big upside potential. However, this, in my opinion, is more so of a hedge, like a hedge fund. Now, technically speaking, you can't even act like a SPAC either because you don't have the proper documentation. However, a hedge fund gathers and takes in individuals and investors' money and allocates it through different means, through different investment vehicles. So we take a look at something like BlackRock, owned by Ray Dalio or started by Ray Dalio. And there's different subsectors in that company, hundreds and maybe even thousands of employees at this point. And each sector in the company, there can be crypto, real estate, foreign exchange currencies. There can like stocks, and in stocks you have technology, you have, and outside of stocks you have bonds. So again, you get the idea is that the investors invest into BlackRock, this hedge fund, and they disperse the money and then give an ROI to the investors at the end of the year with an entire breakdown. Now, let me reinforce this. With an entire breakdown. There's no breakdowns on necessarily what we see happening with our funds in these DAOs. It's kind of just like, hey guys, it's growing, just trust us, pal. That's kind of where the situation is with these DAOs. Next point, and it's going to really annoy a lot of people, but I said this before, and I'm so happy he said this as well. Listen up.
Titano Finance, for instance, has created an elastic supply with a fixed APY of 102,483.58%. Honestly, I don't know where they're coming up with these numbers. I could not.
Wow, when I said this, I got roasted over the coals. Wow. I mean, literally, I'll link that video in the description about Titano as well, that it's unsustainable. Finally, somebody else says it, and he's super, super smart. So I'm happy that my point and my theory was validated by somebody I would consider extremely smart in this space as well. So let's keep going.
Not have made this up if I tried. But what Titano fails to tell you is that in order to maintain this fixed APY, they need to be continuously emitting tokens. And this is the equivalent of hyperinflation. So even though we're seeing the charts, the price is going up, and that attention-starved YouTuber is telling you how much money he made using Titano Finance, when all is said and done, you are going to be his exit liquidity when he...
Correct. This is a traditional Ponzi, and I have no problem saying that. I reached out to the founders of Titano to give it, saying, hey, I would like to do an interview, but I kept going, and because I got so much backlash, and I felt like I was doing something wrong, like sticking to what I believed in and sticking to my guns. But before I even reached back out to them and they said, sure, yeah, why not? I just kept digging into the protocol and digging into what they're trying to accomplish. And I just couldn't muster up the will to want to give them the benefit of the doubt, because it all points to, if it quacks like a duck, it looks like a duck, it's a duck. It is what it is. And DeFi Magick really reiterates this. And when I saw this morning, I was just like, finally, like a breath of fresh air that somebody else sees this and is telling their audience. It's not sustainable. It's physically impossible to sustain. Now we're going to break down 3 of his reasons. And again, they're very valid reasons at that.
That's why DAOs in their existing forms are doomed to failure. Number 1, emissions, in order to maintain such high APYs, are going to offset any potential gains from the Treasury's investments.
Correct. Back to the burn mechanism that I was explaining before. The only way to offset that if there's some type of burn mechanism in place, which again is going to have to be the actual burn for individuals and participants to burn their tokens have to outweigh or the reward for burning has to outweigh the actual burning process.
Number 2, price depreciation is inevitable once the token holders realize that the underlying currency has no actual utility.
Correct. If DAOs were used to do what they were supposed to do, then the utility would be essentially a hedge. And it's funny, ironically, after the collapse of Jade Protocol, Jade started doing this. They have like their Jade fund. Go take a look at them on Twitter and see what they're doing. Now they're using investors' funds to invest into different protocols, and they started already. That's what is supposed to be done from the beginning. But again, they were built on a house of cards as well.
And finally, number three, by capping the supply and ending the rebases, this still does not fix number two. It's not going to give any additional benefit when there's no utility to the token.
Correct. So, sort of. The utility, if done, if applied correctly, meaning distribution and allocation of capital into positive, net positive investments, that can be redistributed back into the treasury, which means the treasury balance would increase from the initial amount that was in there because the ROI from the investment is greater than what was invested. And if it's over years, obviously the treasury is going to increase in balance from that one investment, which means that yes, because the treasury grows and there's more rebases, it will either stay the same or increase in value as well. So I hope that makes sense for anybody that kind of tried to follow that. But let's keep going.
Does this mean that we should all abandon Rebase DAOs? I'm not going to advise you on that either way.
So, long story short, he says he doesn't think that you should or shouldn't. It's completely up to you. And I agree. I, for one, I'm going to go heavy into The Monastery by Immortal Monks and check them out as well. And I'm going to make a video on them this week because they're doing their ICO for holders. And, just talking to them in the background, I know their plan, and thus why I have a way more structured response to this video, because they noticed that as well, given myself, RJ, and a few other creators are talking about them. And I don't know if the other creators have talked to them, but I've been really meticulously going into the admin team and asking them questions, and they've been very responsive. And I really like the fact that basically my answers here in regards to like investment and everything that I'm saying with burn mechanism is coming from them, making me think, etc. So he's got a point. Make your own decisions, etc. And let's keep going over here.
What I will say is that the solutions to the problems that are currently faced by these DAOs involve capping the supply and ending the stratospheric APY.
Okay, so capping the supply makes sense because technically speaking, within a smart contract, even if you're staking the native token and you're getting a rebase, you can set a cap supply of the token and you can have it vested over a period of time. Let's just say there's a 10 million cap, right? If the protocol owners wanted, the developers wanted, they can have those tokens vested over a very long period of time so they're not all distributed up front. And removing the insane APY, I think it's a great marketing tactic. However, I think there should be more education rather than removing the marketing tactic that drives hordes of people in. Because again, if people let it sit there for an entire year, the APY, it's not a lie. It's just there's no education for individuals to think clearly, to leave their capital in there, let the rebases occur, etc. But again, there's a lot more that still needs to come into play here. All right, so let's keep going. His last point.
More transparency in this space. There needs to be more communication among all of the DAOs.
Absolutely. More transparency and more communication with the actual rewards, meaning that I believe, and this is something that I really like, that I know that The Monastery by Monks, I've talked to them. One thing that they're going to be big on is providing monthly or quarterly reports on where the treasury allocation is. Because that's what a DAO is supposed to do. It's supposed to reward its participants via a dividend, an ROI on the money that they invest, because the liquidity is owned by the protocol, right? So with all that being said, DeFi Magick, check out his video. Let him know that I sent you. Follow him on Twitter as well. He has incredible information. Hidden Gem fam, I will catch you all really soon. Have a fantastic day. Bye, everybody.